Welcome back to our channel. Today, we're diving into the world of professional Forex trading, specifically how to spot the footprints of smart money as they move the euro to US dollar market. If you've ever wondered how big banks and institutions make their moves, stick around. By the end of this video, even if you're brand new to trading, you'll understand the core ideas of ICT, inner circle trader, and smart money concepts, and how to apply them step by step. What is smart money and why it matters? Imagine a busy marketplace. Most of us buy and sell based on emotion or news headlines. This is retail money. But behind the scenes, large institutions, banks, hedge funds, and professional traders use vast resources and data. They're the smart money. When they place huge orders, they leave subtle clues on the chart. Our goal is to learn to see those clues. First, we look at market structure, which simply means identifying whether the market is trending up, trending down, or moving sideways. On the daily chart, D1, price went from around 1.0940 up to 1.1580, then pulled back to 1.1200. That forms a higher high and then a lower low, a sign that the market is unsure and could turn bearish. On the 4-hour chart, H4, you can see smaller swings of up and down. Every time price makes a new lower high, it tells us that sellers may be getting ready to push lower again. Knowing the structure helps us decide whether to favor selling on rallies or buying on dips. An order block is simply the last bullish candle before a big drop or the last bearish candle before a big rise. These are areas where institutions placed large orders. On daily, look at the big red candle after the peak at 1.1580. The body of that candle, roughly 1.1420 to 1.1360, becomes a bearish order block, a supply zone where smart money may sell again if price returns. On H4, you'll find a bullish order block around 1.1120 to 1.1140, the last green candle before a sharp rally upward. When price revisits these zones, it often fills institutional orders before continuing the main move. A fair value gap is the price range that a rapid move skips over, like a door that slams shut before you can walk through. On the H1 chart, big drops left gaps between 1.1270 and 1.1240. Smart money often comes back to fill these gaps before resuming the trend. Why care? Because these gaps act like magnets, pulling price back and creating high-probability entry points. Every stop-loss order, those little lines retail traders set below or above key levels, reside in what we call liquidity pools. Big players need that liquidity to fill their giant orders. If many retail traders set stops above 1.1580, the market may briefly spike there to hunt those stops before reversing sharply. On the downside, stops below 1.0940 form another pool. Knowing where those stops live helps us anticipate those sudden wicks and use them as entry triggers. Your easy trade plan. 1. Define your market bias. Look at the daily chart and notice how the big upswing from 1.0940 to 1.1580 has lost momentum. Price struggled to stay above 1.1420 and has been drifting lower. We expect rallies up into resistance to run out of steam. Our main plan is to sell on the next upward move. 2. Draw your key zones on the charts. Daily supply zone. Mark the body of the large bearish candle that formed near 1.1580. This lies roughly between 1.1420 and 1.1360. This is where smart money likely sold heavily. H1 fair value gap. On the 1-hour chart, find the rapid drop that left a price gap between 1.1270 and 1.1240. Label this area. When price returns here, institutions may be filling orders. 3. Wait for zone confluence. Be patient. Only prepare to trade when price climbs back into both zones at once, meaning it must be between 1.1360 to 1.1270. This overlap is your sweet spot. offering the highest chance that smart money will turn price back down. 4. Seek clear candlestick confirmation. Watch for a bearish engulfing candle, a big red candle covering the previous green one, or a pin bar rejection, a long upper wick, inside your confluence zone. These candle shapes show that sellers have stepped in and absorbed the buyers. 5. Place your trade orders. Entry. Place a sell limit order anywhere from 1.1330 up to 1.1370, depending on where the best candle rejection appears. Stop loss. Set it just above the high of your daily supply zone, around 1.1425, to give the trade breathing room and avoid random spikes. Take profit 1. Set your first target at 1.1185, the next significant support area where price stalled before. Take profit 2. Your second, more ambitious target is 1.0940, the prior swing low on the daily chart. 6. Manage the trade actively. After TP1 hits, move your stop loss to break even, your original entry price. This ensures you cannot lose on the remaining position. Trail your stop. Use the average true range, ATR, indicator. When price moves in your favor by 1 ATR distance, shift your stop by that same distance. This locks in profits as price continues downward and keeps you in the move until momentum fades. Why this works? Smart money alignment. We're trading where institutions place large orders. Liquidity insight. We understand and anticipate stop hunts. Risk-reward control. By using clear stops and targets, we keep losses small and profits large. Thanks for watching. If you found this breakdown of smart money concepts helpful, hit that like button and subscribe for more pro-level Forex insights. Have questions? Drop them in the comments below. See you next time, and happy trading.